Hey, welcome back to the channel. Before we dive in, if you're new here and you enjoy breakdowns of companies that are shaping the future of their industries, make sure to hit that like button, subscribe to the channel, and turn on notifications so you don't miss the next update. Your support keeps this community growing, and it's what allows me to keep bringing you deep dives like this one. Also, just a quick disclaimer up front. I am not a financial advisor. Nothing in this video is financial advice, and you should always do your own research before making any investment decisions. This content is for educational and entertainment purposes only. Just a quick disclaimer before we continue. I am not a financial advisor. This video is created purely for educational and entertainment purposes only. Nothing discussed here should be taken as financial advice or a recommendation to buy or sell any security. Always do your own research, consider your personal financial situation, and if needed, consult with a licensed financial professional before making investment decisions. Now let's get into it, because we have a lot to unpack. To anyone glancing quickly at the ticker today, a nearly 9% pullback in OpenDoor might look concerning on the surface. People who are new to trading often see a red day and immediately assume weakness, danger, or even collapse. But if you've been following this stock and this movement closely, you'll understand that what we saw today was not a collapse, it was not a breakdown, and it certainly wasn't the end of the bull case. What we witnessed today was healthy price action, the type of behavior that confirms strength rather than weakness after such an aggressive run-up. See, the market has a rhythm. Stocks never move in perfectly straight lines, whether it's up or down. They surge, then they cool down, they rise sharply, then consolidate, they fall, then bounce. This is the natural ebb and flow of the market, and the best and most sustainable rallies in history are always built on solid foundations rather than unchecked parabolic spikes. In the case of OpenDoor, that foundation is starting to show itself clearly around the $6 support level, which traders and long-term holders alike are now watching very closely. Let's rewind a little to see how we got here. Last week was nothing short of remarkable for OpenDoor. The stock went on a tear, rallying almost 50% in just 5 trading days. 5 green sessions in a row is impressive for any stock, but when you consider that this is a company that has been beaten down, doubted, and heavily shorted, it makes the move even more powerful. Traders who bought in under $5 were rewarded almost immediately, with many seeing outsized gains in a matter of days. Naturally, after such a rapid rise, it was only logical for some of those early buyers to lock in profits. That's normal. In fact, it's healthy. If a stock goes vertical without pausing, it's often a sign of froth, and those rallies usually end in tears because there's no solid base to support them. A sustainable rally, on the other hand, is like building a house. You want strong foundations at every level before you stack higher floors. And what happened today was essentially OpenDoor laying down that foundation at $6. The stock ran intraday to as high as $7.32, pulled back, and still managed to close the session above $6. That tells us there are buyers ready and willing to step in, defend, and accumulate at that price point. For the open army, the passionate retail community backing this stock, that's exactly the kind of action you want to see heading into the next leg higher. Before we keep going, if you're getting value from this breakdown, don't forget to smash that like button, share this video with your friends who are following the markets, and of course, subscribe to the channel with notifications turned on so you never miss an update. Your support really helps this community grow and keeps me motivated to bring you more deep dives just like this one. But let's not limit ourselves to just the chart, because OpenDoor's story is far bigger than a daily candlestick. This is not just about technicals or short-term trading. This is about transformation, reinvention, and conviction. It's about a retail movement that refuses to let go of a long-term vision, and it's about a company that is actively working to redefine how people buy and sell homes in America. Now, one of the most important headlines making the rounds today came from The Motley Fool and MarketWatch, both of which highlighted a staggering statistic. Nearly 24% of OpenDoor's float is sold short. That equates to roughly 155 million shares, betting against this company. To put that into perspective, this makes OpenDoor one of the most heavily shorted stocks in the market right now. And whenever you have a stock with that much bearish positioning against it, the stage is set for explosive volatility in both directions. Of course, it's worth pointing out that not all of that short interest is purely speculative or directional. Some of it comes from more complex strategies, like convertible arbitrage, where funds hedge their exposure in one asset by shorting another. But in the world of trading and investing, optics are everything. A headline number like 24% short interest becomes a lightning rod, and it feeds into the narrative. For retail investors, this isn't a reason to panic. Quite the opposite. It's a motivator. High short interest represents a pool of rocket fuel sitting on the sidelines, waiting to be ignited if momentum continues to build and shorts are forced to cover. And let's be clear, for the open army, a short squeeze is not the primary goal. It would be nice, sure. It would be treasure along the journey, a sweet bonus to collect as the movement sails forward. But the bigger focus is always on the long-term vision, turning OpenDoor into the Amazon of real estate. That's what retail is really betting on. They're not here just for a quick flip. They're here because they see the potential for this company to fundamentally reshape the housing market. Speaking of the retail community, today also brought one of the most unexpected cultural endorsements yet. Comedian Rob Schneider publicly revealed that he had bought into the stock. Yes, the same Rob Schneider known for his iconic comedic roles and for one of the most recognizable motivational catchphrases in pop culture. And of course, it didn't take long for the open army to seize on that moment, flooding social media with his famous line, "You can do it." What's remarkable here is not just the humor of it, but the symbolism. This movement has transcended finance. It's no longer just about Wall Street versus retail or bulls versus bears. It's entered the cultural conversation. When celebrities and influencers start chiming in, it fuels a level of attention and energy that can't be easily quantified, but is undeniably powerful. Even after a 9% down day, retail sentiment wasn't crushed. If anything, it was strengthened. Because the community understands the bigger picture. They know that the story is not defined by one red candle. The vision is bigger than a single session, and that vision is being articulated by activists like Eric Jackson, who has become one of the loudest voices in the movement. Jackson has made it clear that short interest doesn't shake his conviction. In fact, he's doubling down on his activism, pushing hard for board reform, and demanding accountability from leadership. He's even gone as far as calling on high-profile figures like Drake to join the cause. Now, whether Drake ever actually gets involved is irrelevant. The key takeaway is that Jackson is keeping the spotlight firmly on OpenDoor, refusing to let leadership operate in silence, and ensuring that the conversation continues. This kind of activist pressure is rare for retail to see up close, and it's a major reason why the open army feels more empowered than ever. Then we have Keith Rabois, a seasoned Silicon Valley executive with deep connections in tech and venture capital. Rabois has supported OpenDoor's vision in the past, and the fact that he continues to stay close to the company even as it undergoes a leadership transition is significant. Remember, OpenDoor is in the middle of a CEO search, and leadership changes can create uncertainty. But having someone of Rabois' weight stature still in the orbit signals that serious players are still paying attention. It shows this isn't just a retail fantasy. There are legitimate business minds still backing the long-term potential. And that brings us to the transformation at the heart of this story. OpenDoor's original business model as an iBuyer stumbled badly when interest rates surged, exposing the weaknesses of holding massive housing inventory in a volatile macro environment. But the pivot now is toward becoming a platform and marketplace, a digital ecosystem designed to make buying and selling homes as seamless as ordering products online. This is why you keep hearing the phrase Amazon of real estate. It's not just a catchy line, it's a strategy. It's about using technology, data, and artificial intelligence to cut costs, reduce transaction friction, and unlock scale in a market that has been notoriously slow, fragmented, and outdated. Retail investors see this. They're not just buying shares. They're buying into a vision of the future of real estate, a vision where the painful, expensive, and time-consuming process of buying or selling a home is replaced with a streamlined, digital-first experience. That's why they're willing to hold through volatility. That's why they're unshaken by a 9% dip after a 50% rally. Put all these pieces together, and suddenly today's drop looks a lot less like a setback and a lot more like a setup. This was the market doing what it always does after a big run, shaking out weak hands, testing support, and laying the groundwork for the next move higher. The $6 level has now been tested and defended. That gives both traders and investors a reference point to lean on. As long as the stock holds that line, the bull case remains intact. Add in activist pressure, the CEO search, macro tailwinds like potential Fed rate cuts, and the ever-present short interest that could turn into rocket fuel, and you've got a recipe for continued upside. So where does that leave us heading into tomorrow's session and beyond? It leaves us with a stock consolidating after a monster rally, a stock with passionate retail backing, a stock being targeted by short sellers, and a stock energized by activists, influencers, and even pop culture figures. It leaves us with a company that is still in transition, but has a clear and compelling long-term vision. And it leaves us with a technical setup where $6 is the line in the sand, the level to defend before the next breakout. For the open army, today was not a reason to fold. It was a reason to stay focused. It was a reminder that the strongest rallies don't move in straight lines. They take pauses, they consolidate, and they grow stronger over time. It was also a reminder that this story has captured far more than just Wall Street's attention. It has captured cultural energy, it has captured retail imagination, and it has the potential to become one of those rare movements where finance, technology, and community collide in a way that fundamentally changes an industry. So yes, OpenDoor closed down 9% today. But does that change the bigger picture? Absolutely not. The open army is still here, the activists are still pushing, the shorts are still exposed, and the vision of becoming the Amazon of real estate is still very much alive. If anything, today's action was exactly what the stock needed. A cooling off period, a chance to reset, and an opportunity to build a stronger foundation for the next leg higher. Because when you strip away the noise, here's what really matters. OpenDoor has momentum. It has retail conviction. It has activist oversight. It has high short interest that could flip into rocket fuel. And it has a bold vision that, if executed correctly, could transform the housing market forever.